Hello, my name is Joe Lowry Jr., and I'm joined today by Joe Lowry Sr., Cale Flagey, and by our new intern, Javi Ayala Vermont, who has just joined us starting today. And we thought we would do a little Q&A, ask the Joes and Cale, and answer a couple of questions that have come across our desks in the last few weeks that may be helpful for all of you. Please remember that anything we discuss today should not be construed as an offer to buy or sell or hold a security or investment product. And any recommendations or any questions you have should be answered by your financial advisor or other trusted professional. And of course, we're happy to answer those on a one-on-one basis should you have any questions. This is, of course, for educational purposes. So let's get started with a question that hopefully won't get too controversial. But what can we expect from this election season? What are we looking at?
Well, if the numbers now are any indication what will transpire in November, I would anticipate a Republican sweep.
I don't know. Do we want to predict the election outcome?
Absolutely.
All right.
Absolutely.
So, Cale, you may disagree.
Oh, I have no idea what's going to happen. I don't have quite strong of a stance.
Yeah, okay. I think Cale and I are probably a little more
modest,
uncertain about where things are trending. But I guess maybe a better way to ask this question, or something that pertains a little bit more, is from a policy standpoint, as it affects our clients. What can we expect, or what are the main issues that seem to be, or I guess what are the different scenarios we might see depending on what happens in November?
I'll go first. I think if the president is reelected and the existing or the currently implemented policies and the policies that are trending relative to the minimum wage increases, that movement, if it continues to gain momentum, and I think, if interest rates remain high as they are now, or inflation rather, at the same time, I think I think for our clients and for the markets in general, it'll be a very critical test.
Yeah.
For any improvement going forward.
So you would see it likely to put more stress on the markets and the economy.
Absolutely.
I think yeah. The bigger question for us, we often talk about how often we worry a little bit too much about who happens to be in the Oval Office. That the bigger driver of economic activity is what happens in our towns and cities and in the companies that we invest in. Of course, politics has an impact. It really feels like Congress, like the composition of Congress, may be a lot more consequential to policy moving forward, and that's a bigger question mark, and maybe where we're a little bit uncertain about the result is so many incumbent Congress people are retiring or resigning, and that makes it a little more uncertain about who's going to be in office and who's going to control Congress. So I think it's reasonable to expect that if a Democratic majority is in the Congress and the Democrat President Biden wins re-election, that taxes are likely to be higher, and that generally puts some pressure on the economy from a growth standpoint.
So
yeah.
I think, there continues to be this misconception among, at least a part of the public that the government creates jobs and the government creates capital and creates the opportunities. And while social issues, social fairness is important, and in the workplace and in society in general, the bottom line is for our clients is if businesses can make money. And if businesses can make money and be profitable, then our clients will do well. We've already noticed that some major companies are pulling back from some of the DEI moves that they made earlier because they're finding that it's just not working in terms of efficiency and profitability. So, but I think the current administration and its operatives in the various agencies, as they continue to push for that, it places pressure on businesses to put the attention at other places, which in and of themselves are not unimportant, but they don't create bottom line results, and hence, the profitability is not there, the valuations drop, and the economy stagnates. So.
Well, it'll be interesting to see what happens, and if we haven't lost people by starting out with a talk about politics, we'll go to our next question. So, something, Kale, that we shared in the Lowry letter a couple of weeks ago, that you reminded us was about the opportunity to do a Roth IRA for children. Will you share a little bit about how that works and why that might be beneficial?
Yeah, so the Roth IRA is a tax advantage retirement account where the earnings grow tax-free. So if that's something you can set a child up with, they could potentially have over 50 years of tax-free growth on that account. So a small contribution now could make a really huge difference at some point in the future. The adult maintains full control of the account until the child is of age, either 18 or 21, depending on what state you're in. And all that the child needs to do to qualify is to have some sort of earned income. So you can contribute 100% of the child's earned income into that Roth IRA up to the max of $7,000. And the kid, one of the biggest questions we get is how do you prove that income? Because usually if you're a young child, 10 or 12 years old, you might be washing cars, but you're not, you don't have a W-2 from a job or anything like that. And you can actually maintain a written log of the kid's earnings, just in case the IRS did have any questions about it. So it's a pretty simple way to set, kids up for some financial success in the future with a relatively low dollar amount now. A lot of people, their initial reaction is to go for, 529 college savings plan, which, that's also a good idea. But in Florida, where you don't get the state tax deduction benefit from that, it might make more sense to take a look at the Roth IRA instead.
And nothing is more beneficial than time for an investor. And I think you make an excellent point there. So definitely something we encourage people to think about.
I think it's also an excellent opportunity for a business owner who has young children to put those young children on the payroll. And that is another way of generating taxable income for the child that can then be used to justify the contribution to the Roth. So
great. Put them to work and help them shelter that income. A lot of people have questions. So shifting to a different area, a lot of people have questions about what to do with extra cash, with their savings. So what do you think are the most attractive or most appropriate things for people to do if they have money, that they maybe have a year time frame on? In other words, it's not long term. It's not something that this is not retirement money or even money with a multi-year. Where are the good opportunities right now?
I mean, you buy 3-month treasury bills that are paying over 5%. Some money market funds are paying over 5%. If you want something a little more convenient, there's some high yield savings accounts that are FDIC insured. You can look online, places like Wall Street Journal, et cetera, have kind of like a list of some of those, and those are paying kind of in the around 4.5% or so. So that could be a good option for short-term cash for sure.
I would expand the time horizon to include 1 to 2 years. I think if a client has a need, a known need or an anticipated need within 18 months to 2 years, the shorter term yields are the safest and most sure bet at this time.
Yeah, and Kale, you brought up that, you mentioned the money market funds, which are not FDIC insured in many cases, and those high yield savings accounts offered by different companies directly online. And that is a lot of what accounts for that difference in the payout. So those FDIC insured savings accounts are in that 4.25% to 4.5% range, most of them, I think. And those money market funds, money market mutual funds, you can find 5% or more often. Yeah, that's a lot of what accounts for that differential, is that lack of FDIC insurance. And we are still seeing CD rates that are above 5%. If you are looking at 12 months, 9 to 12 months, there's still a lot of availability at that level. So if it's money you know that you don't need access to during that time frame, those are still pretty attractive. Now, why, if those money markets are paying 5%, why wouldn't you put more money there? What's the downside about using that for longer term money with a longer term purpose? What do you think? Is there any downside?
Well, those yields could
Downside.
adjust at any moment. So, if you wanted to lock in a higher yield, you could, miss out by having something like a money market fund.
Yeah, in other words, those money market yields are going to reset, or they're going to adjust when the Federal Reserve adjusts interest rates. And so you could be thinking, oh, I'm going to have this great rate, but 6 months from now, it could be a lot lower than it is today because of the adjustment in short-term rates. So it's still not an appropriate choice for most long-term or money with a long-term time horizon. It really is better oriented towards funds that have a shorter term purpose.
I think the rule of thumb is that you don't make long-term decisions by pursuing short-term results. And so, you focus on the long term. Rarely have we seen anyone engage in market timing over the long term and achieve any appreciable success. In fact, from our own experience with clients who have pulled money out to attempt that with other entities, because we don't do that, I don't think we have one case where they came back and gained any advantage by doing that. So, under the principle, all your money working all the time, whatever you don't need in the short to very near term, put it to work for the long term and let the dynamics of the market work on your behalf, as they have done historically. It's not a guarantee they will in the future, but the past historical numbers look good.
So we don't advocate market timing. It's a very difficult thing to be good at over any period of time. So when should somebody make changes to their portfolio? When is an appropriate time to make adjustments?
Whenever your goals change, or if something clearly isn't working on, like a structural basis, like if you own a company heading into bankruptcy, or you own a index fund in a country that's canceling the stock market or something like that.
Yeah.
But you wouldn't want to try to sell a asset class just because the entire asset class is currently out of favor, like bonds, for example, today. You also wouldn't want to try to find the top on an asset class that's been doing really well. For example, like growth or tech stocks, they could turn the corner tomorrow, or they could keep going for another year. It's really difficult to predict, when that change is going to occur.
Well, unless a person has made a significant investment in sophisticated market research, it's very difficult for an individual with a limited amount of funds, and I'm referring here to anything less than $500,000, to really make, I think, prudent decisions about when to ramp up, when to pull down, when to go in, when to go out, because you lack the ability to diversify sufficiently enough to gain an advantage. And this is why, we will tend, especially in many cases, to use managed portfolios to capitalize on the extensive research that these professional managers have, and to be able to pool their money with that of several thousands of other people, and to achieve a degree of diversification that it's impossible for an individual investor to do. And then on top of that, they just don't have the research capability. So.
Great. All right. Let's see. Other, we get a lot of questions about housing. Any thoughts on the housing market and things people should be aware of? if they are in the market or considering a change in their housing.
I think it's a regional supply and demand issue. I mean, if you look at, places like Florida and Texas, they've had dramatic increases in housing supply. I think they pretty much recovered to levels that they had in 2019 as far as, homes that are available on the market right now. But then California and New York still have extremely low levels of supply, and just because they haven't been building it nearly as quickly as Florida and Texas have. So, presumably in some areas in Florida and Texas, if they keep building, they could actually possibly overshoot on supply and maybe prices stabilize or even start to come down a little bit. But then in other markets, you're probably not going to see that anytime soon.
Senior, any thoughts from you on that question?
Well, I'll pull it back into the individual home buyer. What are the rules governing purchasing a home? Basically, location. Choose the location that's comfortable and convenient for you that meets your needs. Choose a type of living structure, whether it's a single family or multifamily, that lends itself to the quality of life that you're trying to achieve, and then make the purchase recognizing that while that property or that structure may or may not appreciate rapidly or whatever, that any accrual, any appreciation is incidental to why you're buying the home. You look at so many people got clipped in 08, 09 in the build up to that time period because they began to look at their home as this investment, and they were turning properties and buying, pulling the equity out of their home to buy other properties at a discount. Cale referred to the oversupply. We could find ourselves in a situation where there is an oversupply. There will be inevitably. That's the nature of construction, the construction industry. And so, people need to be careful and make sure you're buying for the right reasons, as you would anything else. I think that's what I would focus on. So,
yeah, I think it comes back to that core question or focus on your individual goals and needs. Interest rates are very high right now relative to what they have been in the last 20 plus years. And so that makes it less attractive or more expensive to borrow to buy a home. And so that is having an impact on what people can afford. But that doesn't mean that it isn't the right time for a household, a couple or individual to buy a house if that's really the best fit for their long-term needs, given the possibility that they could refinance later or find themselves because if you're in an area where the housing market continues to appreciate, even if interest rates go down, it doesn't mean that housing will become less expensive or more affordable in that area. So you really have to make those choices based on your personal need. And like Joe Senior said, I think thinking about your primary residence, not really as an asset that's going to be used to generate income or produce a large profit, but something that it's just not something we typically will factor into your long-term income plan and retirement. Now, that's not to say that investment property, that real estate as an investment can't be helpful. It can be extremely helpful. But thinking about personal homes, those are just some thoughts that we have and that continue to make sense. I know in our area, we are seeing more price reductions, more people reducing the asking price on existing residential listings. So there is a little bit of weakness, at least locally, that we're noticing that probably is going to be an issue in other places too. So, all right. Let's see. Any other thoughts? Anything else that you guys have been thinking about or it's come to your mind? Or Javi, any questions from you?
I think I'm good.
All right. Gail, anything on your mind?
It has all been released from my mind.
All right. Senior, anything for you?
no, I'm good. Thanks.
Oh, we just haven't done one of these in a while. We wanted to take the time to share a few thoughts, and hopefully it's been helpful. And we would love to speak with you in greater depth about any of these questions and as they relate to you specifically. We are continue to be true believers in the importance and the benefit of investment in the capital markets. It continues to benefit so many people. The volatility and fluctuations that we experience all the time are part of that. There's a reason why investment can yield good returns. It could not be that way without the risk that we take as investors. And that risk and volatility is just part of the price we pay for that long-term result that we hope to achieve. So again, thank you for watching, and we'll look forward to doing this again soon. If you have any questions, send them our way. Take care.
Take care.